Good day, Creditor learners, and welcome to today's accounting lesson. My name is Mr. Simbi, and this lesson is brought to you by the Gauteng Department of Education in collaboration with Sabono Discovery Center. As the examination is now just around the corner, we need to keep practicing, we need to keep studying. There is no time anymore because the paper one is exactly right at the doorstep. And today, to help you do that, we're going to be doing revision, and I'm going to be focusing on paper one revision. So I'm going to be doing certain calculations which I would want you to follow. So it is very important that in today's class you have somewhere to write. Make sure you have a paper so that you can take notes and do calculations with me. I want to give you this opportunity to make sure that you have your calculator close to you. You need to have a calculator. And make sure you have a pen or a pencil so that we can do some calculations. In today's class, I'm going to be focusing on the statement of comprehensive income, that is your income statement. And I will also look at the statement of financial position. We're talking the balance sheet. So these are the two statements that I'm going to be focusing on today. Make sure that by the end of today's class, you understand these two statements. I will explain them slowly. I'll make sure that I explain every important aspect, and I want you to engage with me. So you have to have a calculator, as I said earlier on. You must have paper to write on, and you must also be able to follow through. When we look at the statement of comprehensive income, it is important that you know its structure. And the structure of the statement of comprehensive income begins with our trading section, which is what you see over here. So on the trading section, that is where you have your sales, and remember debtors allowances. You also have your cost of sales and your gross profit. And then you have your other operating income, where you have items such as your discount received, your rent income, profit on sale of asset. This is very, very important, as most examiners are bringing this in the papers. And then you also need to look at your bad debts recovered, provision for bad debts adjustment. I will touch on this today as well. And then after that, remember that is now your operating section. After that, you will now come to what we call operating expenses. And you have a lot of expenses. And in today's class, I'll be explaining these adjustments. Make sure you do follow in today's class. And then the next section is our financing. That is where we find our interest, where we have interest income, interest expense, and we'll also talk about taxation. Now, in today's class, I'll show you different ways in which the examiner can bring such questions. To begin with, we are going to be focusing on the Free State Prelim paper for the year 2023. So I know most of you have this paper already. If you have it in front of you, it's going to assist as we do some calculations. So make sure you have the Free State paper for the year 2023. And we're going to be looking at their question 1, which was on the statement of comprehensive income. Let's read it. It reads, the information relates to Tukani Limited. The financial year ended on the 28th of February 2023. It is very important, dear learners, that as you are given the 10 minutes reading time in the examination, you need to capture important information such as your dates. The financial year ends 28th February. Already in your mind, you must know when does it begin. It began on the 1st of March 2022. What are we required? We are required to prepare the statement of comprehensive income, that is number 1. We will also do calculations for net trade debtors, that is for the statement of financial position. I'm going to do this with you today. We will prepare the retained income note. So if you have a problem with the retained income note, please stay tuned in today's class because I'm going to do this with you. And then we will also calculate the non-current liabilities in the statement of financial position. There is an interesting adjustment on the loan, and I want to do this with you. So if you also have problems with loan adjustments, I think I'm going to do about 2 loan adjustments with you today. Please follow through so that I can assist you with these adjustments. Let's begin. So the first part is adjustment number 1. Adjustment number 1. And adjustment number 1 reads, goods are sold at a markup of 80%. So here we are told that there are goods which are sold at a markup of 80% on the cost price. And discount for damaged goods sold during the year amounted to 14,600. All right. So what we understand is we are preparing a statement of comprehensive income, and we have some goods that were sold, and they were sold but at a discounted amount, and we're told that the discount for the damaged goods sold amounted to 14,600. So what we're going to do is we want to see how to record these amounts. Let's see how we can record these amounts. All right. So one of the most important things that you have to understand is that whenever we are selling goods, you have to come back to what you have done in your grade 10. That is, every time the cost is 100, so the cost is 100%, and you also have what is known as your markup. Your markup in this case is 80%. So then your selling price therefore becomes 180%. Very important. So far we have 2 aspects here. We have our cost, we have our markup, and we also have our selling price. Once we have this, then we need to know which one of these is given. Which one of these is given in rand value. In this case, we are given the cost, and the cost of sales is 1,845,000. So what exactly do we want? Because we are given the cost of sales here. Therefore, they want us to calculate sales. And in order for us to calculate sales, it is very easy, because you know that your sales is 180. So you then use either what we call the UK method, others call it what you want over what you have, but it simply calculates what you are missing. In this case, if I am to put rand values here, you would find that as we already have our cost, so I can come here and say this is equal to the 1,845,000. Therefore, what is it that we want? We want the 180. So I'll come here, then I'll say what I want is 180. What I have is 100. And what I have has a rand value which is 1,845,000. Now, I want you to have your calculator close, because I want you to punch these figures that I've just given to you. If you punch them, how much do you then get? We're saying 180 over 100 multiplied by 1,845,000. Someone is saying, Mr. Simbi, I'm getting 3 million. Say it again. 3,321,000. So you're getting 3,321,000. This is the sales amount that we are supposed to get. But remember, this is the amount before we have given this discount for the damaged goods. It therefore means if I'm to get my sales after, I'll come here, then I'll say minus the 14,600. This is what it will look like when you prepare now your statement of comprehensive income. Remember what we did over here. We had our 1,845,000. And then we then say multiply by 180%. It is the same as what we said here, 180 over 100. And it would give us the 3,321,000. Then we minus the 14,600, which is the discount for the damaged goods. Then we end up with 3,306,400, which is what we have here. Once you have that, then you can subtract your cost of sales. Remember, amounts that you're subtracting must be shown in brackets, as you see I have done here. Please remember, dear learners, that amounts that you're subtracting, you show them in brackets. And then you end up with a gross profit of 1,461,400. I'll keep repeating this statement that I'm about to make. We will leave no blank spaces. No blank spaces. We must do calculations and do them with all our heart. Let's go and see how adjustment number 2 looks like. Adjustment number 2. Are you ready? It reads, adjustment number 2. Stationery to the value of 22,600 was used. In this case, they are giving us what was used. In other adjustments, the examiner would bring stationery on hand, all right, whereby you are given what was not used. But in this case, the examiner is giving us what was used. You have to remember that what has been used is the expense. So once I get my used, I know that they've given me my expense for the year. And once I have the expense for the year, I have what I can record in my statement of comprehensive income. What do I do then? It means I'll come here in my statement of comprehensive income. Remember, stationery is under operating expenses. So under my expenses, I'm bringing the amount from the nominal accounts, which is 24,684. But I did not use this 24,684. I only used 22,600. So that is what I end up with in my final column. So the difference between these two becomes my on hand. This is what is on hand. Already some of you you know where you're going to take this one. If we were preparing the statement of financial position, this was going to be in note number 4. Yes, it's consumable stores on hand. So here we will come and subtract the 2,084, and then we end up with 22,600. So if I were doing note number 4, I would be having my consumable stores on hand of 2,084 rands. All right. So what was the trick in this adjustment? They gave us the used and not the on hand. But in other papers, they can bring you the on hand. Still, you come and you subtract it so that you can get your used. In the last column of the statement of comprehensive income, we record the used. The used. Are we together? All right. Are you ready for the next adjustment? If you're ready, let us go. Adjustment number 3. It reads, included in the amount for insurance was a yearly premium of 5,520 paid on the 1st of December for the year ending 30 November 2023. Do you remember what I said at the beginning of today's class? In the 10 minutes reading time, you need to capture your dates are very important. In this particular question, our financial year is ending on the 28th of February 2023. All right, this is the financial year end. And then we are told then that there is an amount, a yearly premium. Yearly is the same. In other papers, they don't say yearly. In other papers, they will say annual. It means one and the same thing. All right. So we now need to have a timeline. Let's do this together. The financial year is ending in February. That means if it ends in Feb, it began in March. It ends in Feb, so it began in March. We are then told that there is an annual premium which is paid on the 1st of December. So we're coming here now on the 1st of December. If it's being paid on the 1st of December and it ends on the 30th of November, it ends on the 30th of November. Very important there. All right. We now understand our financial period starts here and it ends here. This is our financial period. But we have paid an insurance premium on the 1st of December and it ends on the 30th of November. Now, with this premium, you have to understand, therefore, that there is a period which we have paid in advance. A period which we have paid in advance. How many months is that? We are therefore going to count from March until November. Let's begin to count. I want to encourage you to use your fingers. So we're going to use our fingers. We're going to count from March, April, May, June, July, August, September, October, November. And they tell us 30 November. Are we together? 30 November. So you have to count November because it's 30 November. But if it was 1 November, you don't count November. But it's 30 November, so you count November. So we end up with how many months? 9 months. So we ended up here with 9 months. So it's 9 over the 12. Why 12? Because here they told us yearly, annual, yearly or annual. So it becomes 9 over 12. Then we say multiply that by the 5,520, which is the amount that was paid. We want to know how much then was paid in advance. Let's punch this in our calculators. All right, how much do you get? Thank you. Someone says, Mr. Simbi, I'm getting 4,140. This is what we get, 4,140. This 4,140 becomes my adjustment. So I'm going to come here, it's 4,140. I'll adjust this in the income statement and I'll also adjust it in the balance sheet. In the income statement, what is this? It's a prepaid expense. And the prepaid expense, I subtracted. Hence you see here, I come and I said minus. When an expense has been paid in advance, in the income statement, I minus it. Please take note of the signs, very important. You minus it in the income statement. In the balance sheet, I have paid an expense in advance. So it comes to my trade and other receivables. We're talking note number 5. So I'll come and say prepaid expense 4,140. That is how I do it. You have to be able to do the adjustments that affect both the income statement and the balance sheet. This is what we have just done now. Okay, are you ready for the next adjustment? Let's look at the next adjustment. And it reads, salaries and wages. It says, adjustments not considered yet. One worker was not paid his salary for February 2023. His details are as follows. So the moment a worker is not paid, that means this is an expense that is owing. Already in my mind, I know this is an expense that has not been recorded. So I must come and I already know that my sign is going to be a plus. I'm going to be adding certain amounts. Let's see if we have more information. We are then given deductions. We have net salary and we have the impressed contributions. And we're told contributions are recorded in the salaries and wages account. Very important, especially when you prepare the statement of comprehensive income, because at times they'll be recorded separately. But in this case, we are told that contributions are recorded in the salaries and wages account. Okay, once we have this, it is very important to understand how to do this adjustment properly. Okay. The starting point is you have to know what is gross salary. Your gross salary is made up of two things. Once you have your deductions, and your net salary, you can get gross, because gross minus deductions is equal to net. I'm going to say that again. Gross minus deductions is equal to net. So if you have your net salary and you have your deductions, you can then get gross. In this case, we are given deductions which are 5,600. Are you still following me? All right. So you are given deductions here, which is 5,600. And you are given net salary, which is 14,500. Net salary, 14,500. We know for certain that if I have my gross and I subtract 5.6, I get 14.5. So if I then do the opposite, I should get my gross. All right. So my gross, therefore, is going to become 20,100. 20,100. That is my gross. That is my gross. So once I have my gross, it is very important that your gross is what we adjust in the income statement. Your gross is what is adjusted in the income statement. Your gross is what we record in the income statement. And then if we were required to do the statement of financial position, that is the balance sheet, we record our deductions and our net salary. All right. So these two would go into the balance sheet. All right. In this case, we were not required to do so. We're not required to do so. So I'm going to do this. Before I even touch the employer's contribution, you can see I am leaving the employer's contribution deliberately because I want to treat it as a separate information. So first, I have my gross, which is 20.1. And we have agreed that if I take my deduction plus my net, it gives me my gross. So in any case, at the top here, I have 20.1. At the top, which is here, I have 20.1. At the bottom here, I also have 20.1. Yes, I have 20.1. You can see that. Okay. So this goes to the income statement. This goes to the balance sheet. In this question, we were not required to do the balance sheet. Now, in my income statement, I would therefore come and I would say the salaries, the amount from the trial balance, which is my 360. And then I'm coming to add my 20.1. And for you to see my 20.1, it is my 14.5 and my 5.6. That gives you the 20.1. So someone would have come and recorded 20.1. You would still be very correct, because in the income statement, we want to show the gross. What I'm trying to tell you is, the moment you are given the deductions and the net, always remember that you must add them to get the gross. And the gross is what we show in the income statement. So even if you show them separately as 14.5 and the 5.6, you are still correct, because the addition of the two gives you the gross. If you brought us 20.1, still very correct, because we record the gross. And these two amounts, that is your deduction and your net salary, this is what is then going to be recorded in the statement of financial position, which is the balance sheet, under note number 9, trade and other payables. Let's suppose the deduction was pension. I'm just making an example. You would find that you would come under your trade and other payables, and you would then be recording your, let's say, your pension. I'm making an example, remember, your pension deduction, and then you would come here and then you would be having your 5.6. And then this net salary, remember, that is what we call what? Creditors for salaries, and you'd be having your 14.5. I just wanted to expand it for you so that you can understand it. Now that I have dealt with these two, I can then come and talk to the employer's contribution. The employer's contribution is how much? 3,800. So my 3.8 will be adjusted then in two places. That is, the income statement as well as the balance sheet. In the income statement, it is coming, there it is. In the balance sheet, it will also go down. Let's suppose it is still pension fund contribution. So I'll still come and say plus 3.8. But remember, this is me just trying to stretch the question, just in case we get such an adjustment somewhere else. In the event that you are given such an adjustment, your deductions and your net, remember, they form gross, and your gross comes into the income statement, and the deduction comes into your trade and other payables, and the creditors for salaries, trade and other payables. And the contribution, you are dealing with it separately. It goes into the income statement and the balance sheet. As you can see here, 3.8, and I also brought it here, or just trying to stretch this particular adjustment so then you can have a better understanding. But according to the demands of this paper, they only wanted us to show it to this level, and this is what we're supposed to do. All right, can I move on to the next adjustment? All right, thank you. I'm going to move on now to adjustment that follows, and it reads, rent was received until 30 April. Okay, so your insurance adjustment, these are adjustments that we always get. Rent adjustment, these are adjustments that we always get. So you should be practicing quite more often on these kinds of adjustment. If you have a problem with the rent adjustment, let's see if we can do this one together. If you're ready, let's go. It reads, as I was reading, rent was received until 30 April. Remember again, dates must be in your mind. So if we have received rent until 30 April, but at the back of your mind, you know, my financial period is ending when? It's ending in Feb. If it ends in Feb, it began in March. Now they're telling me that we received until April. We received until April 30. April 30, we received. Okay? If we had received it from March to Feb, it was going to be 12 months. Now that we've received it until April, how many more months have we received? So we're counting March, April. So we have 2 more months. In other words, we have received rent in total for how many months? For 14 months. How many months are we supposed to receive? 12. We have received now for how many? 14. So there's 2 months received in advance. Already you have that at the back of your mind. Let's continue with the adjustment. The monthly rent was increased. So the examiner can bring an increase or a decrease. Please be watchful for either way, if it's an increase or it's a decrease. In this case, it was increased by 12% on the 1st of November 2022. So we want to know now, if it was increased on the 1st of November, so I'm coming here now, this is November, and we're coming to April. So it was increased on the 1st of November, and we're coming again to April over here. We want to know for how many months was it increased. What do you need? Your fingers. So you're counting now from November, December, January, February, March, April. Remember, we're coming to April. How many months are those? Those are 6 months. So we then say for 6 months, your rent was increased. Your rent was different. And then for how many months had it no increase? Remember, your total that we've received is 14. So if your total is 14, how many months did not have an increase? It will be 8 months that had no increase. All right, so 6 months and 8 months. Hence, we end up with 14 months. The 8 months were constant. There was no change in the first 8 months. The first 8 months are from March until the 30th of October. From March to October, there was no change there. So for those 8 months, rent was 100%. That would simply mean it will give us 800 over here. Are you still following me? Thank you. And then for the other 6 months, which 6 months now? Remember, from the 1st of November until the 30th of April. Remember those 6 months. For those 6 months, it has increased by 12%. So before increase, it was 100. After increase, it has increased by what? 12. Making it what, therefore? 112. So for the 6 months, it is 112. Please grab your calculator. Let's punch this in. 6 by 112. How much does it give you? Thank you. It gives you 672. So you now say 672 plus 800, how much does it give you? Say it again. 1,472. This is what we have now. All right. Let's come and do some calculations. Now we are going to say what you want over what you have. What you want over what you have. What is it that you want in this case? Do you want the months after or the months before? The months before or the months after? In other words, the month of March and April here, which is our problem, is it before the increase or after the increase? It is after the increase. So it is 112. So we then say, we are now saying it is 112 times how many months? Times 2 months. That will give us 224. And then your 224, you divide it by the 1472. Then you multiply all of this by the total rent that you were given, which is 92,736 by 92,736. Let's punch that in the calculator. Let's see how much we get. All right, I'm waiting for you. Okay, then we end up with 14,000. Say it again, 14,112. So this is the rent that we've received in advance for 2 months, that is March and April. And once we have income received in advance, it must be adjusted in 2 places. That is, namely, your income statement and your balance sheet. In your income statement, this is income received in advance, so we subtract it. In a balance sheet, it goes to trade and other payables. All right, let's see. So in our income statement, we're coming and we're saying under other operating income, here's my rent. So I'm taking the amount from the nominal account section, the 92,736. And then remember to open brackets, very important. Opening brackets, very important. Then you come and you minus the income received in advance. You subtract it because we were not supposed to receive it. We must receive only for 12 months. In this case, we received for 14. So the 2 months must be taken out because it is income received in advance. And therefore, we remain with that one. Okay. Remember, signs are very important. Minus, because it is income received in advance. And therefore, if I were doing the statement of financial position, I would come now to my trade and other payables, which is my note number 9. And I would also come and record my income received in advance. And how much is that going to be? My 14,112. Once you've done this, you've recorded it in both the income statement as well as the balance sheet. Are we good? I'm happy. I also have another rent adjustment for you. Please stay put. We're going to do another one again together in today's class. All right, let's go on to the next adjustment. And it reads, fixed deposit from West Side Bank. Okay, so we have a fixed deposit. In 2022, it was 140,000, and then it became 180. That means the fixed deposit has increased. All right, then the interest on fixed deposit that we've received is 12,400. This is the interest that we have received. Adjustments not yet considered or not considered yet. The fixed deposit at West Side Bank was increased. Okay, now that explains why. Here we have 140 and here we have 180. The fixed deposit has been increased by 40,000 on the 1st of June 2022 at the existing rate of 8% per annum. So they're telling us that the interest rate has remained constant. However, the amount of fixed deposit has increased from 140, now it is 180. The transaction was recorded. Make provision for the outstanding interest, and interest is not capitalized. There are several ways in which one would have done this, but let's look at one of the simplest ways. Are you ready? Okay, let's begin. It means at the beginning of this financial year, we had a fixed deposit of how much? 140, you're right. So if we had a fixed deposit of 140,000, And our interest rate was how much? Remember, we're told that it's 8%, 8 over 100. And when did the fixed deposit amount change? It changed when? On the 1st of June. On the 1st of June. So we can therefore count how many months we had this fixed deposit before it changed. When is the financial year beginning? Remember that? March. And when is it ending? February. So we are saying we're beginning it from March, the beginning of the financial year. All right, let's write it down. So the financial year begins in March and it ends in Feb. However, the fixed deposit was increased on the 1st of June. On June 1, the fixed deposit changed. So for how many months was it 140? It was in March, in April, in May. Do we count June? No. Someone tell me why. Because it was increased on the 1st of June. So if it's 1 June, we don't count June. So we're counting March, April, and May. How many months are those? There must be 3. So we come here, then we say multiply that by 3 over 12. Let's see those calculators. Let's see those calculators. How much do we get here? Thank you. 2,800. Am I too fast for you? Okay, I'm going to slow down a bit. All right, let's come to the next part then. So now we know we have 140, which is what we had at the beginning for the first 3 months. And then it increased to how much? To 180. All right, so I now come here and I'm going to have 180,000. 180,000. Are you still following? Remember, they said the interest rate remained constant. The existing rate of 8%. So I'm going to come and say multiply by 8 over 100. Times how many months now? Times 9. Remember, it has to be 12. So the 9 is from the 1st of June until the 28th of February. So it's going to be times 9 over 12. Okay, let's see again those calculators quickly. How much do you get? Thank you. 10,800. We get 10,800. Therefore, it means now, for the first 3 months, we earned interest of 2,800. For the next 9 months, we earned interest of 10,800. For the entire year, we have earned interest of 13,600. This is the total interest that we've earned in this financial year. But according to our trial balance, we have received only 12,400. Hence, the adjustment then read, make provision for the outstanding interest. That means what we have received, which is 12.4, is not what we have earned. We have earned 13.6. So there is some money that we have not yet received. How much is that therefore? We are simply now saying the difference between what we have earned, which is 13.6, and what we have, which is 12.4. It will give us an amount that is 1,200. This is our interest that is outstanding. So, accrued income. In the income statement, it also goes to the balance sheet. In the income statement, if an amount is accrued, outstanding, owing, the sign is always a plus. Accrued, outstanding, owing, it's a plus. In the balance sheet, this is income that is outstanding. So you should go to your note number 5, that is trade and other receivables. You're correct. All right, let's now see how we would have recorded this. Okay, so here's a 12.4 and there is the 1.2. Therefore, we end up with the 13.6, which we had got over here. Are we good? All right. Let's see if we can move on to the next adjustment. The next adjustment then reads, director's fees. I know you love this one. I know you love this one. Let's see if we can do this one together again. Director's fees. The company has 4 directors. All right. Let's see if we can have those 4 directors. Let's have director number 1. Here's director number 1. Director number 2. Director number 3. Director number 4. The company has how many directors? 4 directors. Let's go. each one of them receives the same monthly fee. So it is the same for all the 4 directors. 2 directors receive their fees for the whole year. So for the 2 directors, they've received for the entire year. How many months are in a year? 12. So that means for these 2 guys, this one received for 12 months, this one received for 12 months. All right. Only one, are you following? I'm reading here now. Only one received his for 9 months. Okay, so the 3rd director did not receive for 12 but for 9 months. So already we know we owe him outstanding, owing director's fees. All right, because we paid him for 9 months. Let's hear. And one has already received for March. Oh, so the 4th director has already received for March. When is March, by the way? The financial year, remember what I said? It begins in March, it must end in February. The moment we begin to talk about the next March, it's a prepaid expense already. We're paid in advance. So this guy is not 12, it's not 9, it is actually 13. 13. Are you still following me? All right, let's see those calculators. So we're now going to say 12 plus 9 plus 13. How many months in total? That gives you 46 months in total that we have paid for our directors. It therefore means the amount of directors' fees, which is this one here, the 276,000, is for the 46 months that we have paid. So if the 276 is for the 46 months, how much is per director per month? So we simply take the 276, we divide it by the 46 months, and it will give us an amount of 6,000 rands per month. What does that mean? We're paying each director 6,000 rands per month. Let's start solving our problems. What was our problem? This first director. What was his problem? We paid him for 9 months. How many months do we owe him? 3 months. So we come to that guy and then we say, we owe him director's fees for 3 months. All right. And how much does he get per month? He gets 6,000 per month. That means in total, how much do we owe this director? We owe him 18,000. If we are owing an expense, it goes into your income statement, it goes to the balance sheet. Oh, I know you're following. It's an accrued expense, owing, outstanding. We've not yet paid for it. So it goes into your income statement. What did we say? What do we do with an accrued expense? What is the sign? It is a plus. So we come here, remember, we add it because it's accrued, it's owing, it's outstanding. All right. And in the balance sheet, it's an expense that is accrued, so it still is payable, trade and other payables. This is with the first director there. Then with the second director who has a problem, what was the problem? Oh, we paid him for how many months? 13 months instead of 12. So with one of the directors, we have paid 6,000 per month and we paid him 1 month more. That means we have a prepaid expense of 6,000. That should go into income statement. It should go to your balance sheet. Are you still following me? I like that. So we then come in our income statement. Remember, this is a prepaid expense. What do we do with prepaid expenses? We minus in the balance sheet, trade and other receivables. We're talking note number 5. All right, let's see. That is what we will do in our income statement. Remember the 276 from the list of balances. Then the first one is this guy here who was owing for 3 months. So we come and we add the 18,000 that we are owing him. And then the next one is for the guy whom we paid in advance. Then we say minus 6,000 and that is that one there. Right. If we're doing the statement of financial position, remember, you're going to come to your trade and other receivables and the trade and other payables as well. Okay. Can I move on? Thank you. Let's move on. The next adjustment then says 25% of the audit fees is still outstanding. What does that mean? It means the audit fees that we were supposed to pay was 100%. However, we have paid 75%. This has been paid because we are told that 25% is outstanding. 25% is outstanding. So what we are given, therefore, the 24.6 is what has been paid. So this becomes your 24.6. We're going to use the same method that we've been using from the beginning of this class. What is it that you want? Let's get the outstanding amount because it's easy. We now know what to do with an amount that is outstanding, owing. We always add it. So let's get that one. So if we are to get that one, we are going to get 25, and what we have is 75, and what we have is 24.6. Therefore, what we were looking for is going to be how much? It becomes your 8,200. Then you get 8,200. This is what we then record in the income statement, and this is what we record in the balance sheet. Outstanding. We come when we add the income statement. In the balance sheet, outstanding is an expense, so it goes to note number 9, trade and other payables. Trade and other payables. All right, let's come here, and then we now say audit fees, the amount from the trial balance. Remember to always take the amounts from the list of balances, and then we come here, and then we now say the outstanding amount, which is your 8.2. Then we end up with 32.8. And remember, this also goes to your balance sheet, trade and other payables. Let's go on to the next one. Remember, with the previous adjustment, there were several ways in which you could have done it, but I just did the easiest way. The other way was when you get the 100 over the 75, then you just get your 32.8. I know most of you had done it that way. Let's come on to this adjustment. It says 1,670 was received from a debtor whose account was written off the previous year. Okay, so when we receive an amount from a debtor whose account was written off, we know that is bad debts recovered. That is your bad debts recovered. Okay, the amount was recorded in the debtors control column. Oh, that's a mistake now, because the amount has been recorded in the debtors control. Once an account is written off, it is no longer part of the debtors control. So when that account is then recovered, it no longer affects the debtors control. Are we together? It affects only your bank as well as your bad debts recovered. But these people have recorded the amount in the debtors control. Then they say correct the error. Okay, so the first thing that we would want to know is what kind of an error did they commit? So they came here and they came to the debtors control. Remember, debtors control is an asset. So they came, here's the plus, here's the minus. When you receive money in the debtors control, you credit it. So they came and they said 1,670. This was incorrect. So to cancel this error, you have to come now to the debit side and say 1,670. This is what you do to cancel that error or to correct this particular error. And you then know that once an amount is received from an account that was previously written off, it affects only two accounts. There is your bank and your bad debts recovered. All right. So remember, we're preparing a statement of comprehensive income. So we're going to have the bad debts recovered. Okay. So here's our bad debts recovered. Remember, initially we're 3,850, which is that one. Then we add the amount that was incorrectly recorded in the debtors control. And then secondly, we correct that error. And how do we do that? We come and we add back the 1,670. That is how we correct this particular error. Are we good? Can I go on to the next one? Okay, let's move on to the next one. And it reads, provision for bad debts must be adjusted to 9,360. So once we have such an adjustment, you have to understand again that we must record this adjustment in the income statement as well as in the balance sheet. So I would then say, if you have provision for bad debts which is being adjusted to your 2 goes to the balance sheet. But you will find this adjustment coming in a different way, whereby they will say provision for bad debts must be adjusted by. So once you get the by goes to your income statement. Let's see if we can get the by, because in this case we're going to do the income statement first. To get the by, you are either going to get an increase or a decrease, whereby if you get an increase, this will be an expense, but if you get a decrease, this will be income. But for you to get either the increase or the decrease, you must do a comparison between last year and this year. Last year, the provision for bad debts was 9,820, this one over here. And this year, the provision for bad debts is 9,360, which therefore means the difference here, which is a decrease, because this is this year, 9,360. So you see we have a decrease by, it is decreased by the difference. Calculators, guys, how much is the decrease? 460. And we know once it's a decrease, it is what? Income. So we are coming now into our income statement, provision for bad debts adjustment. We are showing the calculation and we end up with a 460, and remember it's other operating income. But we would also want to show how to record this in the statement of financial position, whereby would come, remember we had our creditors here, so would come and subtract the provision for bad debts. We are taking the 2 amount, there it is. Then if you subtract your 9,360 from your 460,320, you then end up with your net trade debtors. Remember, this was also part of the demands of this question, so I've already answered that particular area. Can I move on? All right, let's move on to the next one. The next adjustment reads, the loan from Westside Bank was taken out on the 1st of July 2019. The loan will be repaid over 10 years in equal monthly installments. Repayments were made from the end of July 2019. Very important here. Once they bring this, they're trying to tell you that we've been paying from the day we received the loan. So we don't owe for the loan. We don't owe for the loan. All right? And all payments were paid and recorded. So they're trying to tell us that we have been making payments right from the first day we took the loan. Okay, let's begin, and we want to see what we are required to do here. So in this case, we will now say the loan was taken on the 1st of July. So it was taken on the 1st of July, that is 2019. And then until the end of the financial year, which is 28 February 2020. That means we had that loan for this year only for 8 months. Can I go on? And then the next financial year began on the 1st of March. Remember, because it ends in February. So it's going to be 1st of March 2020 until 28 February 2021. That is going to be 12 months. I move on. Then the next one is going to be from the 1st of March 2021 until 28 February 2022. That is another 12 months. Okay? And then again from the 1st of March 2022 until 28 February 2023, 12 months until now. So this 20th February is now. And we are told that all payments, including this month of February, have been made. So in total, how many payments have we made? It's 12 plus 12 plus 12 plus 8. Quickly, that gives you 44 months. So 44 months have been paid and recorded. It therefore means if the loan was taken over 10 years, and each year has how many months? 12 months. The loan was supposed to be paid over 120 months. 120 months. But so far we have paid it for 44 months. That means we have paid for them and recorded them. Therefore, we are only owing for how many months now? 76 months. Those 76 months are equal to what is owing, which is 760,000. Then we want to know how much we're going to pay for the next financial year, because for this year we've already paid everything. So our concern is next year. How do we know? We must think about next year, because it is being paid on monthly installments. That means the next month, which is March, we must pay. So we're going to now say the 12 months which we're going to be paying for the next financial year, the short term, divided by 76 multiplied by 760,000. This will therefore give me 120,000. Once I get my 120,000, that is my short-term loan. So I then come in and say my loan, which is 760 from the list of balances, minus the 120 gives me the 640,000. Okay, let's go. The next one. So remember, the 120 is the short-term loan. If you're doing the balance sheet, you're going to show it again under your current liabilities. The next adjustment says income tax is calculated at 30% of the net profit before income tax. The net profit after tax was correctly calculated as 422,450. So if we were preparing the statement of comprehensive income, not if, we are actually preparing the statement of comprehensive income. So what we know already, we're going to start at this point doing the retained income note, because there was a question that wanted us to do the retained income note. So we're starting to do the retained income note as we speak. But let's not forget that we're doing the statement of comprehensive income initially. So that therefore means we would get our net profit before tax, which were we given net profit before tax, which is 100, remember, and then we're told that income tax is calculated at 30%, income tax, which is 30% of the net profit before tax, and then we have net profit after tax, and the net profit after tax is now going to be 70%, and we are told it is 422,450. So we can calculate a number of things here. Let's start with calculating income tax. If we are to calculate income tax, which is that one, we're simply saying what we want is 30 and what we have is 70 multiplied by the 422,450. So therefore our income tax for the year is going to become 181,050. So this would be shown in our statement of comprehensive income, 181,050. Once you have calculated this, remember, if you are also preparing a statement of financial position, that you have made provisional payments of 186. So you then say, if you've made provisional payments of 186, yet your income tax is 181,50. It therefore means you have paid more to SARS. And how much more have we paid to SARS? 4,950. And that goes to your statement of financial position, trade and other receivables. I'm still on this one adjustment. So it was going to affect our income statement. It was going to affect our balance sheet. There you go. All right. And remember, this income statement, we can therefore get our net profit after tax. You now know how to do this. You would simply do it going up. In other words, you're saying 422 plus the 181,050. Reversing the signs or doing the opposite, and then you get your net profit before tax for the income statement. But if you are doing the retained income, as we are now going to do, you will now get your balance at the beginning of retained income, which is this one, and then you have your net profit after tax, which is that one. So I wanted to deal with three things here. Number one, the income statement, which I have done over here. Number two, the balance sheet, whereby we have the amount that we have paid more to SARS. And number three, your retained income, which we will record our net profit after tax. It therefore means we continue now with the retained income. Let's go and see. We're then told that the share capital consists of this, and there are shares that have been repurchased. Once shares have been repurchased, we are told the share capital consists, the share capital consists of 2 million shares, and then 1.2 million of the shares were issued in 2019. So I'm just going to come quickly here and see if I can do a quick note number 7. Let's quickly do that. So we know that we had 1.2 million at the beginning, and these were issued at 4 rand. It therefore means we had 4.8 million here. You still following me? All right. This is why they say it here. And the rest of the shares, because the share capital consists of 2 million, so the 1.2 was issued at 4 rand, the rest of the shares to make it 2 million. So in other words, I'm saying 2 million minus the 1.2 to give me now 800. So I'm going to come here and I'm going to issue 800, the 800,000 shares were then issued at 6 rand. These are issued at 6 rand. That will give me again another 4.8 million. All right. Then they tell us that on 31 December, 12,000 shares are repurchased. So here we now have a repurchase of 12,000. But I know that in my retained income note, I record the repurchase of shares on the average price. So I'm going to bring in the triangle now. We're told they were repurchased at a price of 730. So that is my repurchase price. Remember, that goes to the cash flow, the bank, the repurchase price. That is my 7 rand 30. But I need to record my average price. I don't know it. But I know that if I take my 4.8, I add my 4.8, that is going to give me 9.6 million. 9.6 million. And if I take that 9.6 million, I divide it by 1.2 plus 800, which is 2 million. I divide it by 2 million. It's going to give me an average price of 4.80. So my average price here is 4.80. That is my average price. So I then know that if I say 730 minus 480, I then get my difference or my price above of 2.50. The 2.50 is what I record in the retained income. So I'm now coming in my retained income and I'm saying the repurchase of shares is 12,000. But in the retained income, I show the 2.50. This is the 2.50. Therefore, I show my 30,000. Remember the brackets. But in my note number 7, I would have shown the average price, which is my 4.80. Therefore, I would then get an amount over there. So in this case, I've done with you note number 7, and I've also done with you note number 8, which is our retained income. Let's focus on the retained income. Let's continue. We're then told ordinary share dividends. Okay, under nominal accounts, once we have ordinary share dividends under the nominal accounts, we know those are your interim dividends. So that was easy. 21.6, we put it over there. Let's go to the next one. And then the next one, we are now told that a final dividend, we are now calculating the final dividend, that a final dividend of 2 cents per share was declared. Remember how many shares we had at the end, because we had 2 million in issue, okay, whereby we had issued the 1.2 and the 800, but we ended up repurchasing how many? 12,000. That means at the end of the financial year, we now had 1,988,000. Let's see what they say. A final dividend of 2 cents per share was declared on 20th February. The shares repurchased do not qualify, so we are only going to give it to the 1,988,000. So we are coming here now to say the 1,988,000 multiplied by the 2 cents. That is how we get the 39,760. And then we then add these two to give us the 61,360. Once we do that, then we can now say our balance at the beginning plus the net profit after tax minus the repurchase of shares minus the dividends, then we get the balance at the end. In this case, we have completed question 1 of the Free State 2023 prelim paper. Dear learners, we're going to take a 5-minute break, and then when we come, we're going to do a balance sheet from the Eastern Cape prelim paper for the year 2023. So make sure you stay tuned. See you in 5 minutes time.
Attitude of gratitude. What does that mean? An attitude of gratitude is the quality of being thankful. It's the quality of giving thanks. It's to be grateful. You and I have so much to be grateful for. You and I have parents who make sacrifices day and night for us to be at school. You and I have people who believe in us when we don't believe in ourselves, who love us when we don't love ourselves, who invest in us day and time again. Whether it's a teacher, it's a principal, it's a driver, it's a guardian, we have so much to be grateful for. And so I challenge you, young person, be thankful. Ubonge, lebuha, be grateful each and every single day of your life. Strive to display an attitude of gratitude.
Welcome back, dear learners. Before the short break, we did a statement of comprehensive income from the Free State prelim paper for the year 2023. And with me here, I have a question, and we've adapted it from the Eastern Cape prelim paper for the year 2023. And we are going to do parts of that particular question, which is the statement of financial position. Let's quickly do it. When you are doing your balance sheet, you have to know the format. Very important that you have your assets, and your assets must be equal to the equity and liabilities section. And bank overdraft must appear on the face of the balance sheet. Creditors include SARS income tax payable and shareholders for dividends. Here is the first part of the adjustments. It says, calculate the value of closing stock using the FIFO method. So, in paper 1, you can also get inventory valuation questions. In this case, we got a FIFO question, and we were to calculate the value of closing stock. And we were told that the stock sheet below was omitted when the final stock figure was calculated. So what we want to do is to calculate the value of closing stock, which was omitted. And to do that, we are also given the amount from the trial balance, which was your 2,024,500. And when using the FIFO method, it is easy because we have to get the closing stock of 400 units. So when we look in the month of April, we can only get 350. Hence, you see here is 350. Multiply by the unit price in April, which is 100. And that is what gives you the 3,500. And then you then come here and you now say what we then need is to get, remember, the 400 units. So we then come to the month of November, where we have 640. We don't need all the 640. We just want 50. So that is why you see here we come and we say your 400, which is what we need, minus 350 that we have. So we need 50 there. And the price there is 90. Multiply by 90, then you get 4,500. So we then say your 3.5 plus the 4.5. And then we end up with 39,500. So that therefore becomes the value of closing stock, which was omitted from the stock figures. Once we have that, now we can come and say our inventory, which was in the trial balance, plus the amount that was omitted. Then you end up with the 2,064,000. Remember, we are doing the balance sheet. Okay, so let's come on to the next adjustment. Adjustment number 2 reads, equipment bought on the 1st of January 2017 cost 360,000, was sold for cash for 43,000. So we have sold some equipment here for 43,000 on 29 June. Dates are very important. dates are very, very important. Okay, and then no entries were made for the sale of the equipment. The equipment was depreciated at a fixed amount over 6 years. Fixed amount over 6 years. All right. So it is very important now that you understand that we are supposed to calculate amounts that go, number one, into the balance sheet, and we want to see if we can get an amount that may go into the income statement. But again, we have to remember what I told you at the beginning, the financial period. In this case, our financial year, when is it ending? Our financial year is ending on the 30th of June. So remember, our financial year ends on the 30th of June. This is when the financial year ends. We are told that we bought an equipment on the 1st of January 2017 and it cost 360. But in this case, we are supposed to calculate depreciation, because when we sell an asset, we need to know what was its carrying value. But for us to get carrying value, we have to say cost minus accumulated depreciation to get carrying value. We are not given the accumulated depreciation, so we must calculate it. We are then told that the equipment was depreciated at a fixed amount. A fixed amount, therefore, simply means we are talking the cost price method, fixed installment method, one and the same thing. Okay, so that means we can be able to calculate depreciation for this asset. If the asset was for 360,000 and we are told that it was to last for 6 years, if we divide this by 6, therefore this asset was to lose 60,000 per annum to depreciation. Fixed installment. The only difference is that in this question we are not given the 20% or the 15%. We are given the number of years. But in any case, it must lose 60,000 per annum. So what we'll now do is, in the first year, when we bought it, which is the 1st of January 2017, until the end of the financial year, which is 30 June 2017. This is not 12 months. This is only 6 months. So instead of losing 60,000, it's going to lose half of that, which is going to be how much? 30,000. So it lost 30,000 in the first year. Can I go on? The following year, which began on the 1st of July 2017 until the 30th of June 2018. This is a full year now. So it's no longer losing 30,000, it's losing the entire 60,000. So you come here, it's going to be 60,000. Then the year that followed, which began on the 1st of July 2018 until 30 June 2019, it was 12 months, so it lost 60,000 again. Then the following year, which began on the 1st of July 2019 until 30 June 2020, it lost again 60,000. Remember when we sold it? We sold it on the 29th of June 2023. That's where we are going. So the following year, which was the 1st of July 2020, which ended on the 30th of June 2021, it lost again another 60,000. Then the following year again, which was the 1st of July 2021, which ended on the 30th of June 2022, it lost again another 60,000 until this very same year now. So you will find that so far this asset has lost 30,000, 60,000, 60,000, 60,000, and if you add all of these, you will find that the accumulated depreciation so far of this asset is 60 plus 60 plus 60 plus 60 plus 60 plus that 30, which in total will give you how much? All right. So in other words, you are simply saying 60 times 5, all right, which is your 300,000 plus the 30. So far it has lost 330,000. So far its accumulated depreciation at the beginning of this financial year was 330,000. In this year now, it has been sold on the 29th of June, which is the last day of the financial year. So it must lose again another what? 60,000. That's where the problem begins, because it had a cost price of 360 and it has lost already 330. That means it now has a carrying value of how much? 30. But now it must lose 60,000 to depreciation. Is that possible? No. Already in your mind, you now understand that the 1 rand residual value principle kicks in. That means in this year, this asset, when we got to the end of the year, it could not lose 60,000 like the previous years. It could only lose 29,999. That means it had now reached the 1 rand residual value point. Are you still following me? So when we sold it, it only had a carrying value of 1 rand. When we sold it, it had a carrying value of 1 rand because we had 330, yet its cost was 360, so it had a carrying value of 30,000 at the beginning of the year. And therefore, we then realized that we can't lose the entire 30, we can't lose the 60, so we can only lose the 29,999. So we keep the 1 rand residual value. But now remember, we are selling this particular asset. So what it therefore means, when we are now recording the profit or the loss on sale of this asset, we will now say, we sold the asset for 43,000. This is what we sold it for. We sold the asset for 43,000. Yet it had a carrying value of 1 rand. So how much did we get as profit or loss? We got profit of 42,999. This is what would have gone into your income statement if you were preparing an income statement. Remember, according to this question, they were doing the calculation of correct net profit. I'm not doing that as of now. I'm just showing you what you would have done if you were doing the income statement. You would have shown it as profit on sale of an asset, 42,999. Because we have received 43,000, yet the carrying value of the asset was 1 rand. So we made a profit of 42,999. When we now come to our statement of financial position, we take the amount in the list of balances, which is 7,711,500. And then we know that we had an asset that we were still recording in our books, which had reached the end of its useful life. And we had 1 rand carrying value on it. But now because we have sold it, we have taken it out of our books, we come and we say minus, hence we end up with 7,781,500. All right, there's several ways in which one would have done this, but I decided to do it in this simple way. Okay, I'm going to move on to the next adjustment. And the next adjustment then says provision for bad debts must be adjusted to. All right, remember we spoke about this already, so I'm not going to waste my time. I'm just going to take the amount from the list of balances, then the amount that has been adjusted to, then we subtract that amount. That one was an easy one. Okay, let's move on to the next one. Insurance includes an amount paid. Okay, so this is a similar adjustment. Remember, the financial year, when is it ending? The financial year ends on the 30th of June 2023. That means it began on the 1st of July 2022. But insurance includes a premium, an amount of 40.8 paid for the period January. So we paid it for the 1st of January to 31 December. Okay, so this period here is our problem. And how many months are those going to be? You have your 6 months over 12 multiplied by the 40,800, and that will give you 20,400. What was that? Prepaid expense, income statement, and balance sheet. In the income statement, it's a minus. In the balance sheet, we take it to trade and other receivables. Hence, you will see plus 20,400 because it is receivable, a prepaid expense. Can I move on? All right, let's go on to the next one. And the next one says, rent is received for the period 1st July to 30 September. All right, so remember 1st July is the beginning of the financial year. All right, so 1st July is the beginning of the financial year 2022. And the financial year is supposed to end until 30 June 2023. But rent has been received until 30 September 2023. So our problem here is we have months whereby we have received rent in advance. But we are told this takes into account an increase of 800 from the 1st of April. So we have months with increase and months without increase. Let's see. The months without increase are starting from the 1st of July 2022 and it increased on the 1st of April. So from July until 30 March 2023. These months are without increase. And those months that are without increase will be your 9 months. These ones have no increase. But from the 1st of April, until 30 September, we have now received rent with increase. That is how many months now? Those are your 6 months. 6 months here have an increase, and that increase is how much? 800. So we now say 6 times 8, that is going to give you your 4,800. All right, then you now come and say your 168,000, which is your rent income, minus the 4,800, which is the increase. Then you end up now with 163,200. That 163,200 you then divide it by the total number of months that we have received for, which is your 15 months. You then realize that your rent before increase was 10,880. Then you now say your 10,880, which is your rent before increase. If you then add the increase of 800, that means rent after increase was 11,680. And your months that have been paid in advance are from the month of July, August, and September, which is 3 months, times 3 months. Hence, here we ended up saying 15, because you had 12 months, then plus the 3 which have been received in advance. Hence, we had 15 over here. Then you now say 11,680 times the 3, then you end up with 35,040. This is your income received in advance, income statement, balance sheet. In the income statement, you minus, but in the balance sheet, you take it to your trade and other payables. So you add it to your trade and other payables. Okay, can I move on to the next one? Okay, let's do that. The next adjustment says a creditor with a debit balance must be transferred to the debtor's ledger. Okay, so if we have a creditor, so here I have my creditor's ledger, here's a plus and here's a minus, and here I'm going to have my debtor's ledger, which is a plus and here's a minus. A creditor with a debit balance, so here's a debit balance of 11,000, must be transferred to the debtor's ledger. If I'm transferring this to the debtor's ledger, I'm bringing 11,000 here, which to complete double entry, I'm going to bring 11,000 here. So my signs are going to be a plus and a plus. So I'm going to come now to my current assets under debtor's control. I'm going to say plus 11,000. The sign is very important because I brought it to my debit side. And I'm also going to come now to my current liabilities and I'll do the same and say plus 11,000. The next adjustment is on the loan, and it says information from the loan statement received from Group Bank, monthly repayments including interest of 45,000. Interest on loan is capitalized. Then we're given the balance at the end. This is the balance at the end, and this is the loan at the beginning. So it simply means if I take my loan at the beginning, which is 3,985,000, and I subtract my loan at the end, which is 3,755,000, it will give me what I have paid on the loan. It will give me what I've paid on the loan, which is 230,000. So this year we've paid 230,000 on the loan. This is what we have paid this year. We paid 230,000 on the loan. We are then told the current portion of the loan will be increased by 70,000. So whatever we have been paying, which is the 230, we're going to increase it by 70,000. That means the current portion of the loan is now going to be 300,000 for the next financial year. So it means I'm going to come here and I'm going to say my loan, which is my 3,755,000, which I owe at the end. Next year, we're going to pay 300,000, which becomes current portion of loan, 300,000 over there. Are we still okay? All right, I'm going to move on to the next adjustment. And the next adjustment says, after taking the above omissions into account, it was determined that 65.5 was due to SARS. Okay, so if this was due to SARS, remember we're preparing the statement of financial position, so we're not going to waste time. We're just going to come due to SARS. That makes it a liability. So once it's a liability, we come here and we have our 65.5. And then the next adjustment then reads, a final dividend of 45 cents per share was declared. Now remember, we are doing the statement of financial position. We are given shareholders for dividends here, so that should make it easy. We come here and then we should simply record our shareholders for dividends there. Remember, we had the current portion of loan, we had SARS income tax, and now we just brought in our shareholders for dividends. They gave it to us. But if they gave us shareholders for dividends and they gave us a final dividend of 45 cents, they are trying to tell us something. Let's see what it is that they want us to do. In the next adjustment, it then says, the following financial indicator was calculated on 30 June, the NAV of 420 cents. We understand that when you are preparing the statement of financial position and you're given the NAV and you want to get your shareholders' equity, you must get the number of shares. In this question, the number of shares was not given. However, they gave us is what I showed you in the previous adjustment, where they had given us the final dividend that was given of 45 cents. And then they gave us shareholders for dividends. So they wanted us to calculate the number of shares here. So what one would do was to come and say, my 616,500, if I divide this by the final dividend per share of 45 cents. Remember, we had that 45 cents in the previous slide. That would give me the number of shares that were on hand to declare this final dividend, shareholders for dividends. So you would then see that if you say 616,500 divided by 45 cents, which is 0.45, you would then end up with 1,370,000 shares. So we had 1,370,000 shares when we were declaring final dividends, which therefore means if I want to get my shareholders' equity, I would take that number of shares, which is 1,370,000, then I simply multiply it by my NAV, which is 4.2. Then I end up with 5,754,000. Once I have that one, therefore, it is easy because remember I have my retained income here. Then I can now simply say my shareholders' equity, which is 5,754,000 minus 895 to get your 4,859,000. This was the last adjustment. The trick on this adjustment was they gave us the shareholders for dividends, your final dividends, and they told you that it was 45 cents per share. They were trying to assist you to get the number of shares, which was 1,370,000. Once you get that one, then you can use it with your NAV. And then lastly, this is how the balance sheet is concluded. All right. And then remember, this is the 43,000 from the amount of money that we received from the sale of the asset. When we dispose the vehicle, this is what we received. Remember, whenever you sell, you receive cash, and they told us in the adjustment that we received cash, hence you see that 43,000. And then our question is completed. Now, once you get your total assets, you also come and you get your total equity and liabilities. And this becomes your full balance sheet. Now, dear learners, we've come to the end of today's class, and I do hope that you are going to continuously practice, and I hope to see you again very soon as we continue to practice. Remember, there is no more time. The exam is no longer around the corner. The exam is already here. So please continue practicing. Until next time again, it is goodbye from me.